Hey guys, welcome back to the channel. Now, in this video, both of us are going to share with you what we think are the 3 best and 3 worst company performance in Bursa Malaysia during quarter 3 2022. Now guys, what we say should not be taken as financial advice as usual. Everything we say is purely educational. And as another disclaimer, we do own shares in Paramount Corp. Hey guys, if you're interested in building a 6 to 7 figure portfolio using the power of stock investing, head over to the comment section or the description to sign up for our free masterclass so that we share with you exactly how we do it. All right, Jonathan. So 500 plus companies reported their Q3 results in between the 21st and the 30th of November. So we can give our thoughts, right, on the 3 best and the 3 worst. So let's start with AT Systematization. The market cap is a lot smaller than it used to be.
Yep.
And the year-on-year, I'm guessing this is the earnings, right?
Yes.
Down 3,000% as of 30th of November. So walk us through what's up.
Okay, so just to briefly go through on AT's business, right? So they have 3 business segments.
Yep.
They initially only have fabrication and automation as well as solar renewable energy before they actually dived into glove. Because of all the hype, that's why they went into glove. And you can notice, right, the revenue for glove in their quarter 1 financial year 2022 is quite high as compared to their own core business. Yeah, so they did make some money over there, but then in the recent quarter, it is actually down quite massively. So this is just in the revenue portion only. If you look at the profit portion, the glove is actually now making a loss-making business.
We all know this, right? If you watch our previous videos.
Yeah. So all of the small players who actually diversified their business into glove segment, right now they are actually most of them are experiencing loss-making in terms of this segment. And also their fabrication and automation also is making losses. The only business segment that is actually making them profit, although it's a very small amount, is their solar energy and property segment. Yeah, so that's about it.
That reminds me of that, that Dorito meme, the door with the Dorito.
Yeah.
Anyway.
Yeah. It's only temporary.
Anyway. Okay, so yeah, revenue is up 30%.
It's down 31%.
Down 30%, but the cost of goods sold is up. So that's interesting.
I think this is partly because of the one thing also is glove. The cost of goods. So I believe they don't have any economies of scale. And also their fabrication and automation business segment, I believe that segment also, they don't really have any control in cost.
Right.
So it's based on I believe the inflation has driven up all of these materials that they bought. That's why. But
the business is not doing as well.
Yes, correct. Right. And also another fun fact is that although they are in a net cash position, but their equity finance actually rose, they raised more than like 5x than their market cap.
So you're looking at what, 400?
Yeah, 400
that's
over.
That's
yeah, 450 really. Actually.
This was, I assume, for the expansion for their gloves initially.
Correct. Yeah.
Well, now it's not so nice. They can do something else.
Yeah, and they're in a negative operating cash flow. But the management did say that they expect their fabrication and automation revenue to be better in financial year 2023 as opposed to 2022, and they still remain very positive with glove. Right. So that is AT.
So next is Zen Tech. Hey, it's quite a cool name. 28 million market cap. We are heading to the wilderness in Bursa Malaysia already.
Yeah.
Right?
Micro cap.
88,000%. Okay, so we can see here they are also into gloves, but they've done better.
Yeah.
Right, sales wise.
Correct. Sales and actually profit.
So they've actually done better than
AT. Yeah. I'm not sure what.
But the law of small numbers make it look like they're worse because of the percentage.
Yeah, correct.
But you can see fundamentally they're doing better.
Yeah. So also similarly to AT, they also diversify their business into glove, but surprisingly they are managing the business quite well. I don't know why. It's interesting to know. So overall their revenue is up 35%, but cost of goods sold is up 90%. They are in a net debt. And also, they rose
they also did equity financing.
And it's 3 times more than their market cap.
Yeah, so I think this is a great lesson, right? That if you're going to do equity financing, please do it in an area that has a lot of growth potential.
Yes, correct.
And when you do it, like, try not to go so crazy, like 3 to 5 times.
Yep. And what's interesting is that they also have a 445.6 million capital commitment to build their glove production line. So how are they gonna get actually this money? Is actually through private placement and right issue. So they're gonna dilute shareholder value again.
Damn. Okay.
Yeah. So the last company.
Harvest Miracle Capital. Okay.
Yeah. So this one is like
a name. Okay. Yeah. Okay, so this is in IT.
Yeah, IT.
No gloves. Interesting.
Yeah. So this is a no glove company for the first one, HM. But on surface, it looks like their IT and ICT division. This one is more of like them trading and distributing software and hardware products to consumers. Even though their total revenue contribution is the highest, but if you look at in terms of which segment is contributing, their bottom line is actually their plantation. Yeah, so it's pretty interesting, right? It's like most of their business segment right now is in a loss making, except for the recent business.
And it's new, right? Because 2 years ago, 1 year ago, they didn't have it. And what's interesting is that you're also seeing the property side start to come back up.
Yes.
So this is very interesting because on the surface, it really looks bad, right? But you can see a few silver linings here. Yeah, right, the things might be turning, but who knows? Yes. They're also into money lending. Harvest Miracle Capital indeed.
Okay, so if you look at their income statement as a whole, basically their revenue is down 26%, cost of goods sold also is down 24%, and their operating expenses is up 1%, and that actually costs their earnings to drop 130%.
You know what? It's actually not that bad. When I look at all three, right? So if you look at the first two, sales down, but cost of goods are up a lot. But this one is down as well, right?
Yes.
So it's roughly in tandem, 26-24%.
I think this one also is partly because they are very diversified right? business.
Exactly. So and they're not in gloves. So
yes, yeah.
And then whatever equity financing they did is like way smaller than what they are.
Yes.
They're in a very old economy kind of business, low returns on capital type of business. So yeah, we'll see.
So yeah, actually it's nothing much already. Everything's over here. The only thing that is bringing their bottom line to be positive is actually their palm oil business. Yep. So I think in the next segment, we're going to be talking about the top three best performing companies.
But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description. All right, so best companies, Paramount Corporation Bhd, nearly $500 million in market cap, up 10,000%. Fantastic. So what is going on?
Okay, so Paramount, I believe some of you guys may have heard before about their name because they are in the property space. They do a lot of property development buildings. I believe when I was in my real estate days, one of my colleagues actually sold their projects. It's called Sejati Residence in, I cannot remember where it's in Cyberjaya. Yeah,
right.
Cyberjaya. Right. Yeah, so they are doing property. So far, you can see that their property revenue has been booming. Like it's almost 2 times. Revenue is almost 2 times up. And then I think that's about it lah. And the only thing that is bringing them profit is their property segment. Yes, sir. Okay, so this is actually a very, very long description. So their property is up, their revenue is up 173%. PBT, profit before tax, is up 559%. And OCF, the operating cash flow, is actually up 6 times. Yeah, it's actually pretty impressive. And they are in a net debt position. I mean, obviously, because they need land to build their property.
Yeah, I think that sometimes we like to talk about not wanting to have a lot of that, but I think it really depends on the circumstance. I mean, like properties, you kind of need that lah.
Yeah, I mean, but if you're in a property space and you have a lot of short-term debt, right? Yeah, that one is maybe going to be a concern.
That is a concern.
Yeah, correct. So
non-cash items, impairments, they're up.
Yeah, so they're up like 4 times. So that actually contributed their operating cash flow to be up like 6 times. Their share capital is about 70% of their market cap.
It's classic because usually all these companies like property like to trade at the book value, right? Close to book value.
Yep. So and then they have an unbilled sales of 1.3 billion. Actually, they say that they can collect everything, but also it depends on the construction progress of the project. And then one interesting fact is that they actually now have about 180 million in cash after they sold this DJ campus.
This
and
must
also
be
some shares.
the KDU KDU campus.
This I'm not too sure.
Okay,
yeah,
sure.
but then they sold these two. They got cash, and they mentioned that they're going to distribute like half of it, like 74.6 million as a special dividend.
Slightly under half, but okay.
But they didn't really announce when yet.
Right.
Yeah, but it's already like...
I believe the shares as of this recording is up like 15% on the news, right?
Correct.
Right.
Actually, no, I'm not sure whether have they released 1 month ago or not. About this special dividend. Maybe they have, or maybe they didn't.
Okay.
But yeah, but it's at this current price point, 75 cents per share, right? It gives you about 16% dividend yield. So previously, it will give you about 20%.
Right,
yeah,
right.
So it's a pretty attractive special dividend.
Wait, if he previously gave 20%, it means it's up 20% on the stock, right?
No, it's still up 15%.
Right, 15,
yeah, it's about 58 cents per share.
Sure.
Yeah.
Got it.
Yeah.
Okay, so Hong Leong, okay, this is getting more familiar. 12,000%. Interesting. So it's 3 billion market cap.
Yeah, so Hong Leong, so they make, assemble, and they sell a motorcycle scooter. I mean...
Yep, easy to understand.
Yeah, it's very easy to understand business model. Their revenue is up 219%. Cost of goods only up like 200%, and their operating expenses is up 41%. They are in a net cash position. Right. And what's interesting is that their net cash is actually almost half of the market cap.
Mm-hmm.
Yeah, so it's about, I think their market cap is around 3 billion.
Right.
Their net cash is about 1.5.
So what is quite unfortunate is that on the low in July, they are from $8.57. They're probably up now about 7%.
Yep.
Sorry, more than 7%.
Yeah, it is a very stable company and stuff. Because if you look, I have actually looked back at their operating cash flow and free cash flow. It has been very healthy.
Up 10%, pretty good.
Yeah,
pretty decent.
Yeah, and they are also a very good dividend payer. They have been paying out dividends very consistently. So that's a very great
simple
company.
business to understand. Okay, last one is Bina Darulaman.
Yeah.
All right.
So
back to the nether regions of Bursa Malaysia, 85 million, 14,000%. Okay.
Yeah. So this one also is another property development company.
Yeah.
But the thing is that their property development side of the profit, they are not really making anything.
Okay.
Yeah. They're actually making a loss.
Right.
But although the loss is kind of minimizing right now, and yeah, nothing much.
So the big question obviously is right here. What in the world are others?
So their others is like your golf resort.
What? Okay.
Actually, it's a very interesting business. Golf resort. I cannot remember, water resort or something like that. It's like hospitality kind of business segment.
Interesting.
Yes.
Okay.
Yep. Okay, so overall, their revenue is up 33%. Their cost is also up a little bit lower than their revenues growth, but cumulatively they are actually in a loss making. So only individual quarter it looks like they are profit making, but actually they are not really lah. Yeah, and then they are in a net debt position. They also raise a lot of fund, about 3.5 times their market cap.
Right.
Negative cash flow, and also I didn't know that this company is a Kedah state government linked company. So this is actually very linked to the development of Kedah lah. So if Kedah is booming, PDB also will likely to boom.
Interesting. All right, guys, enjoying the video so far? If the answer is yes, remember, like, comment, subscribe. And as far as comments go, if you don't like the video, do let us know as well. We always take all sorts of feedback, as long as they're constructive. Okay, so as a conclusion, sometimes we like to repeat the same thing that we've been repeating. I think the first is really don't simply just look at quarterlies alone. Yes, definitely you can learn a lot. And some quarterlies, the reporting actually gives you quite a lot of information telling you why it's up, why it's down. Oops, sorry.
Yeah.
And but just look at it cumulatively. Look on an annual or a rolling, what we call a rolling 4Q basis. Now, the second one would be share capital becoming bigger than market cap.
Yeah, so this is actually I have a mixed feeling about this, but generally I dislike when company raise more money than their actual market cap value.
Unless their share capital was so, like, the price drops below the original share capital that they didn't have to raise, but it's unlikely usually.
Yes.
Right, and then last bit is asset allocation.
Yes, correct. So this one, it's more of the glove one, glove business segment. So you notice that those two small companies that they are at the worst performing quarterlies, right? They actually diversify their business into glove. And why did they actually did that? Is it because of being very opportunistic? They want more money, or I don't know whether that's a right decision, but clearly now it's showing that it's not really a good decision. Because some are them even loss making. Some is actually still profit making, but although the number is kind of becoming smaller and smaller.
Fair enough. All right, guys. Thanks for staying all the way. A reminder to like, comment, subscribe. Go follow us on our social media channels, Telegram, Instagram, and yeah, looking forward to seeing you guys in the next video.